Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. Please feel free to call or text me at the number below anytime. For today's mortgage rate update, the prediction that I had at the end of last week is that due to the fact that the Federal Reserve was going to be buying less overall mortgage bond volume this week, and because they are the single dominant force that's impacting mortgage bonds and therefore impacting mortgage rates, my prediction is that due to that decreased volume of Fed purchasing, that we were going to potentially see worse pricing today. What we did see today is mortgage bond price levels at the beginning of the day at what we'll call healthy levels. And actually the rate opportunities this morning up until about an hour ago were pretty much just as good as the best lock opportunities on Friday. Unfortunately, as this pattern has repeated itself so many times now, right here is about when the Federal Reserve stopped its bond purchasing for the day. So this is about 40 minutes to an hour before they usually turn off the taps. And it led to an immediate drop off in the mortgage bond prices. This, unfortunately, as it typically does, triggered rate adjustments across the industry as the big institutional lenders are very sensitive to any drops in mortgage bonds, and they're reacting immediately, almost as if they're anticipating when to make these changes. They know that they're coming, and they do make them very, very quickly. Unfortunately, today I had a case of something I've seen over and over again, which is I did talk to somebody in the morning. Through no fault of their own, no fault of my own, we weren't able to get it locked in time before the prices changed. Now, I wanted to give you some sense of scale. You know, when I talk about the rates changing from the morning to the afternoon, what does that actually mean? What I can tell you it doesn't mean is it doesn't mean we're talking about, the rates jump up 1/4 of a percentage point. What it typically means is whatever rate we're at in the morning, later in the day, there's an additional fee that has to be paid in discount in order to secure that rate. That fee is going to depend on your loan amount, and I want to be very careful not to quote any specific numbers because I really can't. In an online forum, quotes have to be given in a very compliant manner, and that's the reason why I can't quote specific rates in these videos. But what I can tell you is that it leads to basically a higher cost refinance in order to secure the same interest rate. The interest rate's still there. It just requires a little bit more money to secure. So that's what happened today. We've seen the pattern several times over, but here's what concerns me. What I'm concerned about now is that the bond prices here toward the end of the trading day are at this 103.52 level. That's about 50 basis points, or in real normal talk, 0.50 below the highest bond price levels that were sustained throughout last week. So if we bump this out to the 5-day view, I want to show you what I mean. We're down here at this 103.51 level. Last week, we were at 104. We ended the day here, 103.9, 104.2, 104.11, etc. So we're at this relatively sustained bond price level above 104, and now we are decidedly not at that 104 level. And in fact, this morning, prices opened at about 103.8. What this suggests to me is that we may be at the beginning of another cycle toward higher rates. The big question, as always, is what's going to happen tomorrow. If the pattern repeats itself in the way that it has done in the past, we are going to see a period of, let's say, between 3 and 7 days of potentially worse interest rates. It's possible day to day the rates will get worse from one day to the next. It's also very possible that we're going to see the same type of pattern on a day-to-day basis happen again, where you have more favorable pricing in the morning that gets slightly worse in the afternoon. But again, this is if this pattern repeats. And the old adage that past patterns of performance do not indicate future results is key. I think it's very worth keeping in mind. But the pattern has repeated. And if it repeats again, what we're going to be looking at is maybe 3 to 7 days of worse rates, followed by, hopefully, a move back the other direction toward higher bond prices and lower rates. It is anybody's guess. All of the fundamentals in this market are totally out of the window. And one example of that I wanted to mention today is that oil prices went down considerably today. In a normal market, the way I look at the market being in the mortgage business is a little bit different than the way an average person would. Normally, when I see oil prices go down, number one, I'm happy that my cost to fill up my car is less. But number two, I'm very happy because normally that means rates are going to fall, at least marginally. Today, it's not what happened. And that goes to my argument that the single dominant factor controlling mortgage bonds and therefore mortgage rates is the Federal Reserve and their bond buying program. So it will be interesting to see how this pattern plays itself out. I am more than happy to talk with you about your specific scenario anytime. Call, text me at the number below. Please do like the video, share the video, and subscribe to the channel. I'm going to be releasing a ton of different types of videos here in the near future, and I'm anxious to share some of my plans with you all. Thank you very much.